So hi, my name's Roy Thompson. I head up Carpenter Box Financial Advisors. With me on this short video is Henry Wilson. Henry's an investment manager at LGT Wealth. Welcome, Henry. We've obviously spoken a number of times before. The aim of this is really to talk about what's going on in the investment markets, which can quite often be a little bit different from what you actually see in the news. So I guess some key things that I was thinking about, and the reason for sort of perhaps getting on a call. Obviously, UK markets over the course of the last couple of weeks, especially, have really lagged behind. So, what's the reason for that? Some interesting developments in places like China, and we're starting to see a ramp up regarding the US elections, which will be next year. So just to cover some of those bits, Henry, what's your view? What's happening in UK stock market, so to speak?
Yeah, so in the UK land, it's been a bit of a disappointing year. Quite contrary to some of the other markets like the S&P and in the US, or the Nasdaq in the US, or the Nikkei in Japan. Certainly the FTSE's been one of the laggards of the major indices out there this year, and some of it has been to do with the kind of slower and lower economic growth that we are facing here in the UK relative to the US. But some of it was also to do with the fact that the UK has a bit of an issue around inflation relative to the rest of the world. It's been dealing with more sticky inflation than places like Europe or the US, for example. On the other side of the coin, looking at the composition of the FTSE 100, it's made up of very different companies and businesses than the S&P. So in the US, for example, you'll probably be quite aware that the US is made up of more kind of tech-oriented businesses, whereas the FTSE is made up of more kind of cyclical companies such as commodities or mining businesses. Things like Shell and BP, but also financials, so banks and tobacco stocks, and they haven't had such a good year this year relative to those tech companies. If you think about some of the tech stocks, Apple, Microsoft, Nvidia in the US have all done very well year to date. Some of them are up 100 or 200%. In the UK, we just haven't had that same type of return, and some of the UK return also has been diminished by the strength of the sterling this year. Yeah. So when sterling goes up, because of a lot of the UK FTSE 100 companies have a lot of overseas earnings, those overseas earnings are compressed, they're reduced because of the currency impact.
So the inflation story is something we've spoken about a lot on these sort of videos. So it does seem to me that the inflation is hanging around for, well, I say hanging around, it's kind of worse than that. It simply won't go down. You're calling it sticky, or it won't go down at the rate people want. There was some interesting, it's the PMI index, or the Producers Manufacturing Index, I think as it's called, which is sort of an indication of I guess what's going on in with employers and manufacturers and the goods that they're going out and making, and that index has fallen to sort of quite a low point, which is people are sort of driving that information towards a scenario that's an indication that inflation will start to fall away. Is that an accurate statement? How much should we weigh in on?
I think that's a fair appraisal. So the latest reading came out at kind of 47 or so, which indicated anything below 50 indicates that it's in contractionary territory, i.e. kind of it's not growing, it's actually kind of falling. And anything above 50 shows that the index is growing. And the fact that it's contracting would indicate that purchase kind of manufacturers are starting to slow down, and this would really indicate that the impact of higher interest rates is starting to be felt in the economy. So as you raise interest rates, the idea is that higher interest rates slows the economy down and helps tame inflation, and we haven't really seen much of an impact of the higher interest rates taming growth or inflation in the UK that much. It's been much slower than people expected. But this is certainly some good news that things are starting to move in the right direction.
Good news for inflation.
Correct. Yeah. But not good, as you are going to allude to, probably for economic growth. It would indicate that we're heading towards slower economic growth, and the UK has been kind of teetering on the brink of a kind of a stagflationary recession for a while, and that's a situation where you have low or negative economic growth but higher inflation.
So odds to this, of course, the kind of average earnings are still going up at a higher rate than, you know, in historical terms.
Correct.
So is that now, do we see that now as a significant cause of the fact that inflation just won't reduce at the levels that the central banks might want?
Yeah, that is definitely the labour market tightness, which has been one of the major concerns in terms of causing inflationary pressures. The trouble for the UK is that there's no kind of silver bullet to resolving the labour market tightness. Really, you have to bring down demand for labour, i.e., corporates need to say that they're going to stop hiring, but also we need more supply, frankly. We have a bit of a supply issue at the moment in terms of labour, but both the UK and the US, one of the big drivers of inflation has been the tightness of the labour market, and we need to see unemployment rise, but rise to a level that's a bit higher than where we're at today, but not so high that we have economic kind
massive recession.
Yes.
So you mentioned the US in there. You know, they sort of moved. Seems to me that they're moving a little bit more towards this notion of a soft landing, where there is a slight leveling off in the labour market. The inflation figures have come down a little bit further. I guess since we probably last spoke, there was the issue around the debt ceiling, which they raised again. So, but they feel like they're in notionally a slightly better place than the UK.
Definitely. We think that kind of the key word when we think about the US this year is resilience. They've been much more resilient against the backdrop of higher interest rates than many people expected coming into the year. You know, everyone was talking, not just in investments, but, you know, magazines and newspapers were saying we were going to have a recession this year. And you know, when we talk about recession or markets, the main focus is always on the US because it's the biggest market and it's the reference market for other indexes and other financial instruments. It just hasn't happened. They've been remarkable this year. Everything that people thought was going to happen hasn't happened, and they've been very resilient. And inflation is very much coming down in the right order, which is good. We've seen the headline inflation has fallen quite quickly now, and also core inflation is starting to fall as well. And core inflation is essentially it strips out the kind of variable components that the Federal Reserve say they can't control, and that's things like food prices and energy prices. And that started to move down as well. So moving in the right direction, but very much like the UK, the key thing for the US and inflation will be getting the unemployment and the tightness of the labour market under control. If the tight labour market has been one of the big drivers behind the US consumer being so strong. And the strong US consumer has been one of the big drivers of inflation. So if they can really tackle that, that will be one of the things that helps it. But at the moment, there are quite a few million jobs that are still that need to be removed, i.e. Companies that have open jobs and searching for people that need to be removed before you can address the imbalance, because there's a shortage of labour versus demand in the US.
Yeah, and that's not an easy task, is it, to resolve? The US election, then, is that too early for that to be causing sort of concerns from an investment point of view? Obviously, the debates have started.
Yeah, it's probably a little bit too soon. On the one hand, Biden's approval rating is pretty low, and you know, for a variety of different reasons, probably because of inflation. You know, voters don't like having their real earnings eroded. But on the other hand, on the Republican side of things, it looks like if there is going to be, you know, if there is a Republican candidate, it looks like it will be Trump. But we just don't know what will happen with him because of all of the kind of uncertainty around whether he will even be electable this time kind of next year. So still too early, I think, to make any investment decisions around that. And we generally try to avoid making decisions unless there's a very, very, very strong, making investment decisions around political events unless there's a very strong rationale. And for example, in the UK, when you had the potential for Corbyn being elected versus a Tory candidate, there was a very, very, very stark kind of policy difference between the two. in the UK and a little bit in the US, actually, the difference in policy between kind of the Tories and the Labour right now, between kind of Sunak versus Starmer, for example, is much reduced, and the same probably for the US. And the reason for that is that um, spending, there's both the UK and the US have a massive double deficit, i.e., the fiscal deficit at the moment, and that will constrain spending plans because they're already spending more than they receive from tax receipts, and so different policies for each party seems relatively unlikely to be too extreme. That is.
Mm. We referenced that, or referenced the debt ceiling in there. That seemed to come and go without too much of a hiccup. It was almost like they knew it was going to be voted up again. But
Yes.
it almost seems like a pointless level now, because every time
Yeah.
it comes up, they just vote to increase it. Is that
It seems a
how
bit
the
of a
market
charade,
sees it?
actually.
Yeah.
I think it's a bit of a charade. It seems to happen every few years. And they just kick the can down the road for the next kind of election or the next kind of major date. I think it does also show, though, that it goes back to this idea of what I said about the US being much more resilient than people expected. We've had the debt ceiling, that's been and gone without too much of an issue. We had the Silicon Valley Bank collapse and then the folding of Credit Suisse into UBS. And the market, except for a couple of days here or there where we've had big drawdowns, the market's largely taken it in its stride. And so despite the fact that we've seen 5 percentage point increase in interest rates, things have kind of been largely quite benign in the US, and they've been able to kind of take these things in their stride, which is generally the sign of a market that's operating quite effectively. It's generally the sign of an economy that's quite strong. So all relatively quite good news, actually.
Mm-hmm. And then look at that's kind of the Western world, but looking in China, then, so they've actually reduced interest rates recently. So that seems to be that they're at the opposite end, or that they're trying to promote growth and inflation.
Yes.
Say inflation, but consumption they're trying to promote.
Yeah, it's absolutely right. I think look, China's been one of the real disappointments this year. I think, I mean, it has been a disappointment, but coming out of the COVID lockdowns, everyone was quite hopeful that this would provide a good stimulus to China and that the growth would get back to the attractive levels that they had beforehand, and you would get the same sort of boom that you had in the West. But as far as we can tell, there's a little bit of what would almost amount to post-traumatic stress disorder coming out of very, very aggressive lockdowns and zero COVID approach. So we never felt that coming out of COVID would be a kind of a straight line. There's always going to be volatility and variability around that, but it has been much more disappointing than expected. Now, what we have seen in the last few weeks is policymakers have come out with a variety of different measures. The early measures that they came out with early part of this year were not, frankly, they weren't strong enough, and the market kind of met it with a bit of disappointment, and you had what was known as a bit of a buyer's strike with regards Chinese equities. But back end of July, we saw the Politburo meeting. They came out with some really strong policy measures. Some of the big Chinese stocks were up 6-7% in a day. Some of the property stocks were up 10% or so. So they've definitely come out with measures in the last few weeks that have said, we know that we need to get things back on the road. In particular, the property market, they're trying to underpin that. But we do think that there needs to be more measures, not just cutting rates. They cut policy rates by just interest rates by just kind of 10 or 15 basis points. It wasn't nearly enough. There was a reason for that. There's a technical reason about trying to protect the banks there and things like that. But generally, we think that there will have to be more strong measures to try and underpin the market. So keep your eye out for their valuations, and currency is very, very cheap there. Some companies are trading at less than book value. That means that you could essentially take the company, break it up into all of its little parts and sell them individually, and you'd end up with more than it's listed on the exchange today. That's probably unsustainable. We haven't seen valuations like this for over a decade, really. So that does provide us with some comfort. But it might be that there's another big policy meeting in October, November time. And ordinarily, it's that meeting in October, November time that sets pro-growth policies for the next 3 to 5 years. So watch out for then. The big thing really is just how much they've got in the tank. We've been looking out for what's known as a policy bazooka, which is a really strong policy that comes out and creates that catalyst or that stimulus to get growth back going and gets the buyers coming back in. We haven't seen it thus far. It's been more kind of the handgun rather than the bazooka, using the kind of the analogy of the bazooka.
That's great. So, you know, the China story is, well, it'll be interesting to see how that evolves. Then, of course, over the next few months, you reference October, November, when they have the next major meeting, so to speak. So,
and we still remain massively optimistic about Asia as the whole. Not just China. Super exciting opportunity, not just in the short term, but also long term. That remains absolutely an area that we're very optimistic about.
So the news is unchanged in the sense that inflation is driving the whole story. It's just evolving as time goes by, as it seems to me. You know, the inflation story started with policies that come out the back of COVID and an influx of money that moved. Then when there was the Ukraine war, implement further issues in the supply chains. That they've now been around for a period of time, and the outcome from that is higher pay increases, which is making the inflation a little bit more sticky. And I guess we will see how that evolves with interest rates and the reaction to those interest rates over the course of the next few months still. But the other thing I know is very much geographical changes. So you mentioned about the US. US markets are up quite strongly this year. UK markets are actually down. So it's quite interesting now how you're getting quite a divergence between the two. I think you were saying earlier about the currency.
Yes.
I presume that's effective for a UK investor in the US. I presume the currency has gone against them, so it's nullified some of those.
That's right. So if you look at the S&P or the Nasdaq in the US, year to date, the stock market there is up kind of, let's say 13-14%, or the Nasdaq is up much more. It's up more than kind of 35% or so. But as a UK investor, you haven't felt that same impact because the currency has gone against them. So because the sterling has been strong, those dollar indexes are worth less from a UK investor's perspective. So let's say in local currency terms, i.e. in the US, if it's up 13-14%, the UK investor may only be seeing 7 or 8% on a valuation this year. But the thing with currencies is their swings and roundabouts. They come around, they move around, they're very hard to predict. But the main thing is that you might find that one month it's in your favor, the next month it's against your favor. And so we do things to try and lock in and monetize profits around currency. But in the long run, the main thing we're looking for is earnings growth going in the right direction. And that's what we started to see this year in the US. It's been much more resilient than people expected.
That's good. Henry, I really appreciate your time. I think that's probably plenty enough for the time being, but I appreciate you joining me.
Anytime, Roy. Thanks a lot.
Thanks
Have a good day. Cheers.
Bye. Bye.